Stop trading breakouts as if every candle crossing a line is an entry signal. Most traders do not lose money because breakouts are useless. They lose because they treat every move above resistance or below support as if the market just gave them permission to enter. Price breaks above a high, they buy. Price breaks below a low, they sell. And many times they enter before the candle even closes because they are afraid the move will leave without them. But that is not reading the market. That is reacting to the fear of missing out. A real breakout is not confirmed just because price crosses a level. It is confirmed when the market proves that it can accept the new price, hold it, and continue from there. That difference may seem small, but it is the difference between entering with patience and becoming liquidity for someone else. In this video, you are going to learn how to spot a fake breakout before you get trapped, not as a trick, not as a magic signal, not as an isolated rule, but as a way to read what is really happening between buyers and sellers. By the end, you will know exactly what to look for before entering, which warning signs should make you suspicious, how to use candle closes, volume, retests, and follow through, and why many breakouts that look perfect are designed to attract impatient traders. Let us start with a simple idea. Imagine a door. Just because someone walks through that door does not mean they moved into the building. They may have stepped inside for a few seconds and walked right back out. The same thing happens in the market. A wick can move above resistance, a candle can move below support. But if price cannot stay on the other side, there was no acceptance. There was only a visit, and many times that visit happens for a reason. Orders tend to sit around the most obvious levels on the chart. Above a previous high, you will often find buy orders from traders waiting for confirmation, along with protective exit orders from traders who were already short. Below a previous low, you will often find sell orders from traders waiting for a bearish breakout, along with protective exit orders from traders who are already long. Those areas are visible, and that is why they matter. The market needs liquidity to move, not because there is a mysterious person watching your individual trade, but because a large number of orders tend to gather around similar locations. When price reaches one of those locations, it may cross the level, trigger those orders, and immediately come back. That is a fake breakout. It is not just a chart mistake. It is information. It tells you that the market was able to cross the level, but it was not able to hold on the other side. And that failure can reveal much more than the original breakout attempt. Let us define the difference clearly. A real breakout happens when price moves beyond an important level, closes outside the structure, and shows a clear intention to continue. A fake breakout happens when price crosses the level, attracts traders, triggers orders, and then moves back inside the structure. The exact shape can vary. Sometimes you will see a long wick. Sometimes you will see a full candle close outside the level, followed by another candle that gives back the entire move. Sometimes price will move slightly farther before reversing. That is why memorizing a shape is not enough. What matters is understanding the story. The first question is not whether price broke the level. The first question is where the breakout happened. Location changes everything. A breakout above resistance inside a clean bullish trend does not mean the same thing as a breakout above resistance after an exhausted move with extended candles and extreme volume. A breakdown below clean support does not mean the same thing as a bearish push inside a range filled with wicks, noise, and previous failed moves. Before entering, look to the left. Ask what the level actually represents. Is it a recent high? Is it a level that has already been tested many times? Is it the edge of a range? Is it a clear resistance level? Is it an obvious low that everyone can see? Is it an area where orders are likely to be concentrated? The more obvious the level is, the more patient you need to be, because obvious levels attract traders, and when too many people expect the same thing, the market often puts them to the test. This is the first filter. A breakout needs context. Do not buy just because price crossed a line. Do not sell just because one candle pushed below a low. Ask why the level matters and what happened before price reached it. Now let us move to the second filter, the candle close. This is one of the details most traders ignore. They enter while the candle is still forming. They see price move above resistance and feel urgency. They think that if they wait, they will miss the opportunity. But an open candle has not told you who won the battle yet. It is only showing you a battle in progress. A wick above resistance means that price traveled there, nothing more. It does not mean buyers conquered the level. It does not mean the market accepted higher prices. It does not mean the breakout is valid. For a stronger reading, you need to see where the candle finishes. If price moves above resistance and then closes back below it, the message is clear. Buyers tried to advance, but they could not hold the territory. If price moves below support and then closes back above it, the opposite is true. Sellers tried to push the market lower, but they could not maintain control. Remember this rule: the wick shows the attempt, the close shows the result. Now, closing outside the level improves the quality of the breakout, but it still does not guarantee that the breakout is real. This is where many traders make the second mistake. They think that one candle closing above resistance is enough. It is not always enough. A candle can close outside the structure and still turn into a trap during the next candle. That is why you need the third filter: follow through. A real breakout should show the ability to continue. It does not always need to explode immediately, but it should show signs of acceptance. Price should be able to stay outside the level. The next candle should not give back the entire move too easily. Buyers should be able to defend the old resistance as a new support area. Or during a bearish breakout, sellers should prevent price from reclaiming the broken support. Think about the door again. Crossing the doorway is the first step. Staying inside is the second. Starting to occupy the space is the third. If someone walks inside and runs straight back out, they did not conquer anything. They only triggered a reaction. Follow through helps you separate real intent from a temporary push. A genuine breakout does not need to look perfect, but it does need to prove that the dominant side can maintain pressure. If the breakout is followed by a strong opposite candle that pushes price straight back into the range, pay attention. If price becomes indecisive around the level with wicks in both directions, pay attention. If the breakout happens and price shows no ability to advance, pay attention. The market may be telling you that there is no real acceptance. Now let us move to the fourth filter: volume. Volume is not an automatic signal. You should not look at a large volume bar and assume it means buying. You should not look at a red volume bar and assume everyone is selling. Every transaction needs a buyer and a seller. Volume measures activity. It measures participation. It measures how much interest exists at a specific level. The useful information appears when you compare effort with result. Imagine pushing a door with a lot of force and barely moving it. There is resistance on the other side. Something similar happens in the market. If price breaks above resistance with a wide candle and volume increases clearly, effort and result are aligned. There is participation and there is also movement. That improves the quality of the breakout. But if volume becomes extremely high and price barely moves forward, that is a warning. A lot of effort, very little result. There may be absorption. Someone may be taking the other side of that pressure without allowing price to continue. Now imagine the opposite. Price breaks resistance with very low volume. The candle may move forward, but participation is weak. That should also make you suspicious. It may mean there is not enough interest to sustain the move. It may be a temporary gap. It may be a fragile breakout. You do not need to turn volume into a complicated system. You only need to ask one question: does the effort match the result? If the answer is no, wait. The fifth filter is the retest. After a breakout, price often comes back to the level it just crossed. That return does not happen every time, but when it does, it gives you valuable information. During a bullish breakout, broken resistance should start behaving like support. During a bearish breakout, broken support should start behaving like resistance. The market comes back to the door to check whether control really changed. If buyers defend the bullish breakout and price reacts clearly, the story improves. If sellers defend the bearish breakout and price rejects the level from below, the story improves. But if price moves back into the range too easily, the story changes. There was no defense, there was no acceptance, there was not enough control. There was a visual breakout, but not a functional breakout. And this is where one of the most common traps appears. A trader buys the first candle that crosses resistance, then price returns to the level. Instead of waiting, the trader interprets the return as an opportunity to add another position, but the level does not hold. Price moves back inside the range. The breakout fails, and the trader is trapped with one bad entry and another entry that is even worse. Do not confuse a retest with an excuse to justify a trade. Watch the reaction first. Decide after. The sixth filter is structure. Not every resistance level carries the same weight. Not every support level represents the same thing. A breakout inside a messy market can look impressive and still mean nothing. If price is trapped in a narrow range with overlapping candles, long wicks, and constant changes in direction, a small breakout may be just another piece of noise. But if price breaks a clear structure, closes outside it, and maintains control, the reading becomes stronger. Ask what price is actually breaking. Is it moving above an important high? Is it escaping from a clean range? Is it confirming a trend? Is it invalidating a previous sequence? Is it changing local control? Or is it simply crossing a minor internal level inside a confusing market? This detail matters enormously. Many traders react to every move because they are looking at the chart too closely. They treat every small swing as if it were a decisive signal. But when you zoom out, you often discover that what looked like a breakout was just a wick inside a larger structure. Take a step back, look at the full context. The most attractive breakout is not always the most important one. Now let us talk about the trap itself. Because a fake breakout is not just a breakout that fails, it is a situation where one side of the market becomes exposed. Imagine price reaches an obvious resistance level. For several minutes it looks like buyers are building pressure. Finally, a candle moves above the high. Traders who are waiting for confirmation buy. Short sellers with protection above the high exit their positions. A wave of buy orders appears, but price does not continue. A long wick forms. The candle closes back below the level. The next candle drops sharply. Ask yourself who is trapped. The late buyers. Some will close quickly. Others will keep holding, hoping price comes back. But if price keeps falling, their exits add even more selling pressure. The fake breakout created fuel for the move in the opposite direction. Now imagine the bearish version. Price reaches clear support. It moves below the low. Sellers enter, expecting continuation. Previous buyers exit their positions. A wave of sell orders appears, but price cannot stay below the level. It closes back inside the range. The next candle rises sharply. The late sellers are trapped. If they exit, they have to buy back, and that buying can feed the bullish move. This is the key point. A fake breakout matters not only because it failed, it matters because it can trap a group of traders on the wrong side of the market. That is why you should always ask these questions. Who just entered? Who just exited? Who may be forced to close if price reverses? Those questions change the way you read charts. You stop looking at isolated candles. You start reading pressure. Now let us compare two scenarios. First scenario. Price has been moving inside an irregular range for several hours. There are wicks above and below. The boundaries are not clearly defined. Every breakout attempt returns quickly. Suddenly, a large bullish candle moves above an internal high. Many traders buy, but price is very close to a larger resistance level. Volume does not increase in a convincing way. The next candle loses momentum. The next one moves back inside the range. That is not a clear opportunity. That is a breakout inside noise. There is no space. There is no acceptance. There is no follow-through. The candle may look impressive, but a beautiful candle does not fix poor context. Second scenario. Price has been consolidating below clear resistance. The lows start moving higher gradually. The pullbacks become shorter. Volume increases during bullish pushes and decreases during pullbacks. Finally, a wide candle closes above resistance. The next candle does not give back the move. Price returns to the level with lower volume, reacts and continues. The story changes. There is structure, there is participation, there is acceptance, there is defense. That scenario does not guarantee a perfect result. Nothing does, but it gives you more consistent evidence. And your job is not to search for certainty. Your job is to demand enough evidence before risking capital. Now here is an important idea. Not every fake breakout should be traded in the opposite direction. Sometimes a fake breakout creates an opportunity, but other times it is simply telling you not to enter. That distinction protects a lot of accounts. When price moves above resistance, fails, and returns to the range, do not sell automatically. First, analyze whether there is a clear area where sellers can take control. Look at whether the rejection candle is strong. Look at whether local structure breaks. Look at whether there is enough room for price to move lower. Look at where the invalidation point would be. Look at whether the relationship between risk and available space makes sense. The same is true for a fake bearish breakout. Just because price moves below support and comes back does not mean you should buy immediately. You need to see whether buyers are actually taking control. A trap is evidence. It is not a button. This principle applies to all of trading. A candle is not a button. A pattern is not a button. A zone is not a button. A breakout is not a button either. Everything is evidence, and the quality of a trade depends on how the pieces fit together. Now let us talk about time frames. A fake breakout on a small time frame may not mean much if it happens against a powerful higher time frame structure. For example, a bearish wick on a very small chart may look like a buying opportunity, But if the 1-hour chart is clearly falling, that small reaction may just be a pause before price continues lower. That is why you need to read at least 2 time frames. Start with the higher time frame. Ask whether the market is moving up, moving down, or moving sideways. Then use a lower time frame to study the reaction around the level. The higher time frame gives you direction. The lower time frame gives you precision. Do not reverse that order. If you start with the small chart, every move will look important. Every wick will look like a trap. Every big candle will look like a signal, and you will end up reacting to noise. Start from the top, then move down. Now let us talk about a psychological mistake. The fear of missing the move. That fear destroys patience. You see a breakout and think that if you wait for one more candle, you will enter too late, so you buy before the candle closes. But think about this. If the trade only works when you enter impulsively during the first few seconds, it was probably not a solid opportunity for you. A quality setup usually gives you clear logic. It may not always give you the perfect price. Sometimes the move will leave without you. That is normal. Missing an opportunity is not the same as losing money. The market will still exist tomorrow. Your capital also needs to exist tomorrow. Impatience turns the absence of an entry into a feeling of loss. And when you feel like you already lost something, you start chasing it. That is when the market charges you for your mistake. Do not chase extended candles. Do not enter just because the chart is moving fast. Speed creates emotion, but emotion does not replace analysis. Now turn everything into a simple process. Before trading a breakout, ask 7 questions. First question, where is it happening? Is it an important level or just another line inside the noise? Second question, did the candle close outside the level or did it only leave a wick? Third question, did the market manage to stay outside the structure during the next candles? Fourth question, does volume support the move or is there a contradiction between effort and result? Fifth question, was there a retest, and if there was, did the old level change its role or did price return to the range too easily? Sixth question, does the breakout have enough room to develop or is price moving directly into another zone? Seventh question, who could be trapped if the breakout fails? These questions do not promise perfection, but they force you to stop reacting. They force you to observe. They force you to wait for evidence, and that alone puts you ahead of a large number of traders. Let us go through a complete example. Price approaches a resistance level that has been respected several times. Buyers push forward. The candle moves above the level. You still do nothing. You wait for the close. The candle leaves a long wick and closes below resistance. Now you know the attempt failed, but you still do not sell. You watch the next candle. The next candle breaks a local low and closes with conviction. Volume increases. Now there is a story. Buyers tried to break out. They could not hold the level. They became trapped. Sellers responded. Local structure started to shift. Then you look for a logical entry. Maybe you wait for a pullback. Maybe you watch to see whether price returns to the rejection zone. Maybe you decide not to trade because the next support is too close. That is also a good decision. You do not need to trade every story you understand. Understanding the market and executing a trade are 2 different decisions. Now let us go through the opposite example. Price falls toward important support. It moves below the low. Many traders sell. You wait. The candle closes back above support with a long lower wick. The next candle moves higher and breaks a local high. Volume supports the move. Price returns to support and reacts. Now you have a stronger sequence. There was a move below support. There was rejection. There was recovery. There was confirmation. There was defense. You still do not have certainty, but you do have a structured reason to evaluate a buy. That is trading, not guessing, not chasing, not reacting, evaluating. Now listen carefully. A fake breakout is not your enemy. Your enemy is entering before the market reveals enough information. A fake breakout can help you. It can show you where liquidity was sitting. It can teach you who became trapped. It can reveal a loss of momentum. It can help you avoid a bad entry. It can even create an opportunity in the opposite direction, but only if you are patient. The impatient trader sees movement. The disciplined trader sees context. The impatient trader wants to get there first. The disciplined trader wants to arrive with evidence. The impatient trader is afraid of missing the trade. The disciplined trader is afraid of entering without a clear reason. That difference may seem psychological, but it becomes financial. Now bring everything together into one final rule. A real breakout needs 3 things: acceptance, participation, follow through. Acceptance means price can close and stay outside the level. Participation means there is enough interest to support the move. Follow through means the next candles do not immediately give back the breakout. If one piece is missing, do not rush. Wait. If two pieces are missing, step away. If all three are missing, you are probably looking at a trap. The next time you see price move above resistance or below support, only whether the level broke. Ask where it happened. Ask how the candle closed. Ask whether price managed to stay outside. Ask whether volume confirmed the move. Ask how price reacted during the retest. Ask who became trapped. And ask whether there is still enough room for the trade to make sense. Because a breakout is not confirmed when price crosses a line, it is confirmed when the market proves that it can live on the other side. Open a chart after this video. Find an obvious resistance level or support level. Look at what happened during the most recent breakout. Was there a close outside the level? Was there follow through? Was there a retest? Or did price cross the door and come straight back inside? Write in the comments which signal you ignored most often until now. The candle close, the volume, the retest, or the follow through. And remember this, you do not need to enter faster, you need to filter better. Because in trading, patience does not make you lose opportunities. Patience keeps a fake opportunity from turning you into someone else's opportunity.